This lecture is on interpreting liquidity and leverage ratio. It's intended to give you a better understanding of how to understand some of the ratios that you have been computing. Getting started here, we have trends, and these trends are guiding us. They can indicate and they can indicate where we may want to look further. So we can look at trends and say, are there changes? If there are changes, why? Interpreting is not the definition of what the ratio is. We can assume that we all know what the definition is. Now, oftentimes we need to understand what we are seeing from sometimes a different perspective. Don't always look at it as a good or bad with a ratio, keeping in mind there is a numerator and denominator, and both of them have an impact. So when we're looking at a change in a ratio, we have to say, is it driven by the numerator or the denominator? So sometimes we have to go deeper, do more research. Sometimes we need to take things within context of the company, its business plan, its industry, and the macro environment. We need to understand why we are looking at something, because everything we're looking at, besides computing the ratios, we're doing for a purpose. So understanding why we want to look at it and what we get from it is probably a good way to get started. Let's just take a look at the definition. Is what does interpret mean? Making sense, assigning a meaning in a verb, make sense of a language, given an interpretation or rendition, restate from one language into another, create an image. So when we look at that, make sense, create an image, but the language that we're doing is the language of ratios into what does it mean for the company. So we're doing some translating too. There are three parts to interpreting liquidity and leverage. The first is computing the ratios. That's what you've done. Organizing them so that we can interpret them. Develop an understanding of the relationship between the numbers. How are they related? None of the ratios that we talk about on their own are meaningful. It's only when we start putting them together. And then we draw a conclusion of what we have looked at. So that's the basic that goes with any analysis, but we're going to focus in this course primarily on liquidity and capital. Now, what do we know when we look at liquidity? We're making an assumption that the firm is a going concern. It's not going out of business. Okay, so we can't say, well, current ratio is good or bad because it can pay off the debts, because it is going concern. The analysis may show potential risks with the ability to fund an organization in the future. Okay, it may indicate when we're done that the firm is not a going concern, but it's what's the risk in the ability of the firm to keep operating. Okay, where are the funds going to come from? We want to evaluate the ability of the firm to generate cash for the operating cycle, capacity to grow, operational efficiency, and opportunities to improve cash flows. Improving cash flows can increase profitability, but you need to generate enough cash in the operating cycle to pay for it. So we want to look at liquidity from that perspective. Now, as we keep going here, we're really looking at quality and with quantity. And with quantity, we are starting with the working capital, current ratio. Timing is everything. And we look at that as cash conversion cycle. We can look at it in days. We can look at it in dollars. Are we going to find some things that are weird? Yes, but that means we need to go and research what those items are. So if you think a cash conversion cycle doesn't look right, that means you're putting on and making an assumption about something, and your assumption is not correct. So you're seeing something different than what you would anticipate. So that means we need to look further. Velocity is very important in a firm, because if a firm can process their workflow, the working capital cycle, and they can do it quickly, they will need less of it, thus being more efficient. The last piece is quality, or how good is it? And this we look at inventory turnover, accounts receivable turnover, inventory working capital, trade receivable to working capital. Now, if we have a negative working capital, what I do is I tend to look at inventory instead of the working capital to gross working capital. So we can see of those assets that are in working capital, how liquid are they? Cash is most liquid, followed by accounts receivable, followed by inventory, followed by others. So depending on how much we have in each category can tell us about the quality of that, where the working capital and current ratio only tells us the quantity. Okay? So where does cash liquidity come from? From the business cycle. Generating cash from operations. That comes from the cash flow station. Free cash flow, which we know comes from the cash flow statement less capital expenditures and acquisitions, which is free cash flow. Remember, free cash flow is available to pay dividends, buy back stock, pay off debt, make acquisitions, and buy back stock. We could issue equity. That's where cash can come from, or from the issuance of debt. So these are the four places that a company can get cash. Okay, so that's the cash piece. Let's talk about interpreting capital structure. Now, capital structure is just the combination of the mix of debt and equity which a company uses to finance its long-term operations. Each company has an optimal structure that balances leverages and risk. So if we look at this chart, the highest risk for an investor is equity. Okay? They absorb the losses. So when we look at risk, there's also a cost. So equity does have a cost. And then when you have losses or the company is falling into behind on things, this is where the losses start with equity, the hybrids that we have, subordinated debt, senior debt. This is for bank term deposits. And then last but not least, senior secured debt. And that's a bond that has pledged property or something like that. So that's sort of a little bit about it again. There's a whole lecture on capital structure that you should have watched. So now we say, well, what are we looking at? Well, each company has this optimal structure here that we can look at, but it's based on the company. What are we trying to do? First thing is we're going to compute all the ratios for capital and interest and debt coverage. So we're going to lay them all out. Then we're going to focus on those that we can select to tell the story the best way. Want to know, is the firm highly leveraged and thus more risks and limits to growth? Do they have too little debt and not taking advantage of leverage? What's the relationship between the debt service, fixed charge coverage, and free cash flow? Are they going to have enough cash to pay not only the interest, but the principal on these loans too? This can give us a very good sense when we look at liquidity, and we can look at the current portion of long-term debt. Sixth thing is, does the firm have enough capital to grow? Sometimes a company may have a reasonable working capital, but when we start breaking it down and seeing what's needed for growth, it may not be there. So we're trying to determine, are they highly leveraged? And that's the relationship between equity and debt. And we can look compare it to peer groups. So that's sort of the theory of all of this. What we're going to do now is let's take an example. I'm going to run through a couple of examples, and let's start with steel dynamics, which you're familiar. So our starting point for steel dynamics is I calculated out all of the ratios for capital structure. I did all the debt to equity, total debt, total capital, debt to equity. Now let's start all over. So we go back to Steel Dynamics, and I brought in all my 10K data. I have my income statement, my balance sheet, my cash flow. Then I started computing ratios. So I went and computed all of the liquidity type ratios. I did all gross working capital, net working capital, all of these, free cash flow. I used all three. Then I went and computed the cash conversion cycle, and I did my graphs, and I got a picture of what's going on with the company. So that's the first step, is you do all of these, and we're looking at them. So what did I decide to look at? I started to look at it within the context of what's the quantity. So I laid out the trend of the working capital, $2 billion, and it grows. And I'm seeing the current ratio is still very strong at 4. Now, we just can't look at that current ratio. Let's see what's happening with the velocity or the speed. So what we're seeing here is we're seeing that it takes, when we're looking at 2018, we see that it takes a while, so almost 2.25 months, to be able to move the inventory through. But as you can tell, we actually were much lower in the prior years. So that might be a question. At the same time, we saw a speed up in our accounts receivable. Now, a lot of receivables, terms with the customer are 30 days. So anything that's over 30 days, significantly, we need to take a look at. And when we look here, 41 and 39, that is pretty high, and it is coming down. So the total working capital conversion time is 103 days now, but that's the operating cycle, the working capital cycle. They pay their bills, 20, 62, and the cash conversion cycle is about 82. Okay. We then look at the quality of the working capital, as you can see here. I then brought in the simple cash flow from operations, and current portion of long-term debt. Now, why did I put these three pieces together? Is there going to be sufficient cash from operations to pay the long-term debt? And what we can see is, yes, there is. Then I take and I break down working capital per day historically. Okay, and it's 32,000, 21, 17. It's gotten up there, but remember, they're doing more value-added products. So when I use 32.3, they need $2.6 billion in working capital. They have $3 billion, so they have excess. If we're looking at this, we have excess working capital, which means we can grow the company with existing revenue, with existing working capital. We don't need to add any. So, and if we go back and look, sales did grow year on year because there was significant working capital. I then computed all of that out and found out that I could grow by 2.8. I'm making this available. So this is sort of the data that I put down into, that I looked at. So I took everything that was on this page, I organized it, what's important. Now, let's take a look at how I actually presented that in my analysis. So what I did is I brought that summary information over so that as I'm trying to put an analytical report together, I've taken the key pieces of data to be able to share. So I've done the work, I've summarized it. But what I put here is, just again to keep this in mind, this is the cash to buy the raw materials, to make the finished goods, which turned in accounts receivable, and that's the cash flow cycle. That's what we're looking for. Is there enough there to support the business? Is there enough to pay off current maturities of long-term debt? Will there be enough? So what did I write up? Well, here's my interpretation. And this is where I'm making assumptions and drawing things. STLD has enough working capital to support the operating cycle of the business as it is today, and an approximate growth in sales of approximately 2.8. The speed of the accounts receivable has been improving, but at 32.17 is above the terms, 30 days, that they give to customers. There may be opportunities to reduce this by stronger collection processes. The speed of accounts payable is very fast, as they are paying vendors faster than the normal 30 days, leading me to believe they're taking advantage of vendor discounts for faster payment. The inventory turnover and conversion time appears adequate for a manufacturing company that converts raw material to a product. It's increased as prior years as they've added more specialist value-added products, which take longer to produce. And this needs to be monitored for inventory build. The historical cash flow from operations and free cash flow generate amounts to serve current portion of long-term debt and lines of credit. So that's what I did, and so I've looked deeper. I'm trying to tie them all together. Let's take a look at steel dynamics from a capital perspective. What I brought over was the leverage ratio, debt to income, debt to equity, tangible net worth. I took out the goodwill to figure out what that is, and then the debt to tangible net worth, interest coverage ratio, and fixed charge coverage. So my comments, we're seeing a positive trend. They're able to generate more coverage for the interest for the debt they do have and their fixed charges. It's a fairly very strong number, 13 times. Banks sometimes are only looking for 2 to 3 times coverage. Conclusion, STLD is not highly leveraged based on the positive trend in the leverage ratio and debt to equity. Adjusting for intangibles and goodwill, the firm is still not highly leveraged. The company's strong equity position would enable it to absorb substantial losses. The decrease in leverage over the past 5 years, combined with increased profitability, has resulted in a very strong fixed charge coverage and interest coverage. And lenders, the debtor, those that hold the debt, are well protected. The firm has completed acquisitions primarily through cash flow from operations and has the capacity to borrow additional funds for acquisition. The strong capital is also a protection against the cyclical nature of the steel business. So that's the first example. If you go on to the second part of the lecture, we're going to take a look at a couple of other companies too.